This is the Traders Exclusive Live Trader Showcase for March 2024. This is a quarterly event where we feature expert traders to bring you training and insights from 20 different expert traders. So please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. So I want to thank you all for being with us again. I'd like to introduce Larry Gaines of Power Cycle Trading.
Okay, well, thank you so much for having me here, and let us get going. So yeah, what I'm going to talk about today is how to trade uncertain markets. Two really great low risk, high return option strategies. They're good for any environment, but especially when we get into more uncertainty where we want to kind of really keep that risk controlled. So that being said, let us get started. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, I've been trading options now for over 30 years, and what I've found that the most valuable go-to option strategies that can literally help any trader or investor more than any other strategy out there, especially during times when we get an extreme market uncertainty, is really going back and looking at the option butterfly and the long condor. They're kind of what I call my trading secret weapon. So the huge advantage that these strategies have is their unique option framework that is designed to take advantage of time decay, or theta, and then volatility, which are the two main option pricing components. So this helps to stack the trading odds in your favor, and then can be used for any type of market environment, which really makes them a favorite trading strategy when you get into more market uncertainty. It just comes down to then just knowing when and then how to use these particular strategies. So when we look at the butterfly and long condor, they're very dynamic and they can be traded for a variety of different reasons. So different goals in mind. So in other words, you're going to be learning how to use the butterfly and long condor, and it's going to keep you covered for both your offense, your profit, and your defense for protection. So your goals and protection. So they're very, very flexible types of strategies to use. So these two strategies can work no matter what the markets are doing. It could be an up, down, or sideways market. Can provide income from stocks that are going nowhere. Really helps to eliminate the stress of having to be perfect on a stock's direction or overall market, and eliminates the time decay expense that you're going to encounter from long decay in options. So it really helps also to take the unsettling guesswork out of your trading, and these types of strategies can be structured for very, very low cost and low capital risk, which make them ideal for uncertainty. Now they can also offer, returns of 10 to 1 or higher. And so you're going to see, a couple examples here today of, like 10 to 20 to 1 returns, which is pretty amazing. So they do a lot of great dynamic things. Now the butterfly and long condor, they can also be used for your hedging. So when you, mess things up. So at some time you're going to, have a problem with your trade and you really need a kind of a fast, low-cost way to cover your what pronto when that position starts to move against you. And literally I found no other hedging strategy that comes close to incorporating either a butterfly or a long condor hedge to a core position. So by constructing the butterfly or long condor around a strike that is under pressure from another core trade position that you have on, such as maybe you do credit spreads or a debit spread, it's really the best way that I've found to immediately neutralize, but not only neutralize, you're going to be able to lower your capital at risk on any kind of trade setup by doing this hedge. And I had one member, this is what she said, Pam, she said, wish I'd known how to do this hedging before I lost so much money on credit spreads. And so if you've done credit spreads, you kind of know what Pam's talking about. You can have a lot of success and then all of a sudden one of them blows up by going through your short strike. So, we'll talk about these are strategies that can help eliminate that type of mess up in your trade. Now, when we look at the butterfly, kind of basically it's a simplistic structure, but there are a lot of different variations to it. But here's an example of, like, if you had a call debit spread, let's say you're long a call, short a call, and in this example, your total at risk is $300. So you're long here, this is like the 10-10 strike. This was on the NASDAQ one, NDX. and then you're short this 10/20. So it's a $10 wide spread or $1,000 wide per option contract. Your risk is 300, your debit cost. So your return is the difference, potentially of $700. Nice risk reward type trade setup. But if we wanted to reduce this and hedge it real quick, we could quickly neutralize and lower that risk by adding another spread, a credit spread, and creating basically a butterfly. So we could sell a call here, buy a call here, and now we've created another $10 wide spread. We've taken in a credit of $200, and so then that leaves our potential risk. It's a negative risk ratio when you do credit spreads of $800. So if we combine the two together, then we've completed a kind of a simple butterfly trade, and now we've reduced our risk down to $100. And so if the trade or whatever security we're trading in this example was to go out at the top, we call this the 10 of the butterfly, the potential for this would be a $900 profit. All right, so the spread width you can see is 10.10 to 10.20, 10.20 to 10.30, so $10 wide or $1,000 spread width. Now we've reduced our risk to a debit cost of 10, and so the potential is for a 900% return if it's to go here. But anywhere inside this 10, we still make a really good profit, and you can look at the potential return on this type of spread. So in this example, it's 900% if you were to hit the top of that 10. Now, the next one is what we're going to talk about today. Is called the long condor, very similar to the butterfly, but what I like about this one is it widens out the profit zone. So we're not going to have to thread that needle as tight, as when we use a butterfly. So the condor is another really great, strategy to incorporate in your toolbox of different strategies to use. And pretty much everything we do at Power Cycle Trading, we use option strategies. So these are two that we use quite a bit. Now there's some other ones, but these are really great, again, when we get into, high uncertainty. Now the core concept that make the butterfly and long condor dynamic really comes down to the two most important option factors for, profit generation in general. And that is to understand how option pricing works and the concept of time decay or theta, and that its effect on the price of your option. So let's kind of take a kind of core review here so you can kind of get on the same page. Now, when we look at the option theta value, what theta does, it tells us how much an option price is going to go down over time. So it's the rate of the time decay of your stock's option. And by expiration, theta is going to go to 0. So this is one thing that we can take advantage of, in our option trading. If we do a strategy that takes advantage of theta decay and implied volatility decay, then we can incorporate that and to put that into our, use and advantage of the trade structures that we do. Here's a kind of a simple example to kind of illustrate, the butterfly math. So here's like XYZ, and it's trading at $45. And in this example, we're just looking for a move down to 43, just a small move, directional move to the downside. So what I like to do is when I look at a target that I want to, target for a target move up or down for a profit, that is pretty much what becomes the body of the butterfly. So in the example, we're looking for the market to go lower. So we're going to target 43. So in this example, bought the March 44 put at $2.38 a debit cost, and then sold the March 43 put, brought in $1.67, sold $1.67 again on that 43, and then bought the 42 put. So that basically constructed a narrow wing butterfly with the body right there at the 43. All right, so if you look at the cost of the trade, you've got that 238 debit cost, $1.06 here. Then you sold the short strike of the 43 put twice for $1.67 times 100, the multiplier. So the total cost per spread on this butterfly example would be $10. And then your potential profit is just the spread width, which is, $1 wide, a middle strike lower, less your debit cost, which was 10 cents. So potential here is to make $90 per spread, and that on the risk of 10 would be a 900% return, or you're risking $1 to make 9. So the risk reward of all the different option spreads that are available to trade, this butterfly will have the highest return on capital of any of the other types of option spreads. So it really is amazing, and you'll see some really cool examples of how that works. So then the next thing comes to, well, how do you choose the best butterfly or long condor for your trading and your trading goals. So in my opinion, one major goal for every trader is to select trades that are going to be based on what's going to provide you the most consistent possible returns with low defined risk and not always the greatest. So I always tell my members and clients, we're looking to hit singles and doubles, but with options, then occasionally we're going to hit one that turns into that home run. So the name of the game is to be consistent, to stay in the game, and then you're going to hit these bigger returns. And by using options, we can do it. And these are two spreads that are great for that. Now, one of the best ways then to achieve this goal is to be aware, what are the different option strategies out there and available to you, then understand how they work, and then go about selecting the one that's going to be best suited for the market environment you're trading and for your specific goals. So for everybody here, Vivian or Charlie, or Vivian might have, $5,000 account and Charlie might have 100,000. So it's going to make a difference in your trading goals and risk parameters. But one thing is for sure is when you use the Butterfly or Condor, you can use it for any size account. You can use it for one contract, or you can do thousands. I've done butterflies, when I was doing the butterflies and stuff, for big hedge funds. I had one hedge fund, they did 20,000 butterfly spread. And so, or you could do one. So it's just a really unique strategy that anybody can use. Now, when I look at the butterfly, I call it kind of the butterfly family, because there are a lot of different variations and ways to apply it. But when we go through it, there's what we call just a basic long call or put butterfly. There's a broken wing butterfly that we use calls or puts on. Sometimes it's called a skip strike. There's what I call the ninja or unbalanced ratio butterfly. There's the iron butterfly. There's the lotto butterfly, which is really cool. I'll show you a really great example there. And then there's just a whole other category, hedging defenses using your butterfly. And then what I kind of consider the cousin, which is the long condor spread. So it really gives you a lot of variations and flexibility for the different environments you're trading in. So let's take a look and review some of the different structures here so you can get an idea of how they work. Now, the next thing, when we look at a butterfly spread, we can adjust the risk and the profit based on the wingspan of the spread. So, if you are a butterfly collector, it's going to be much easier for you to collect and catch a butterfly if you use a wide butterfly net versus a small net. So we can kind of do the same thing with butterflies. So if we want to really widen our profit zone and have a bigger zone of profit, we can widen out that butterfly really wide. But if we want to really shape our risk and really narrow it, keep our risk very low but still give us a big return, we can have a narrow wing butterfly like this. And then we've got all the different variations. We can have a broken wing butterfly, things like that. We can have, all kinds of different structures. Ratio butterflies, it's just, it's like, Forrest Gump and Bubba Gump shrimp. I like shrimp souffle or whatever, barbecued shrimp, all that. So it's kind of like the butterfly. So the first example I'll show you is kind of a narrow wing butterfly. So this is going to be like 10 cents or $10 wide, or which would be 100 per option contract. And the other great thing with butterflies, are fantastic for ETFs and index options. So we do a lot of butterflies with, SPY or the Russell or the QQQ. Plus they offer, these weekly options, which are a lot of times you have the dailies that you can use. So a lot of flexibility with your structures. So here's an example of a narrow wing butterfly, and this was on SPY. So I also like to incorporate Fibonacci levels and use that a lot into my trading to identify target points and breaking points for stop loss. But in this example, we had a high here to a low, and so we were targeting this 618 retracement right there. So that was coming in about 274. So there was a really good option activity as well, and there's this kind of price action resistance, and then this fib level. So we were targeting this area here. So that's going to be the target of the butterfly. And in this example, was going to keep the risk super low. So did a target trade targeting that 273 strike here. So bought the 272, sold the 73, bought the 274. So narrowing butterfly. Cost of the trade was $10, 10 cents per debit spread, or $10 per option contract. The spread width was $1 wide or 100. So your potential profit then, if it went out at your 273 would be $90 per spread or 900% return. So risking $1 to make $9. Now this spread went out making $70 per spread, which is a 700% return. So still a great return on your capital at risk. So here's what it looked like as far as the trade. So it's going out right up here towards that top of the tent. And it was trading almost right there, almost nailed it. It was trading right at 273.08 and right at that top of the tent. So this went from 10 cents here, now it's trading at 80 cents, or there's your profit of $70 per spread, which this was on 4 contracts, so $280. So we had a 700% return in a 2-day period. So advantages, again, time decay, volatility crush, and high implied volatility. Now the key takeaway too is that this has a sell side component. So when you sell options, you're selling time and you're selling volatility. And at expiration, those 2 pricing components go to 0. So that sucks out a lot of your, what you're getting from the premium. And as you get closer to expiration, that goes straight into your pocket. So it's a really great feature for the Butterfly and Condor. That's really what really can make a great performance out of these 2 structures. So the next one, we use a lot of wide wing butterflies, and that's because these are going to provide us a higher profit zone. All right, they're also going to be structured again for defined risk and hedging. They're a debit cost trade, great for directional, swing trades, where a trade that can last 1 day to 2 weeks. So butterflies are perfect for that. Also use them a lot for what we call pinning trades, where there's a certain strike that we're looking for, maybe the market to expire at. So fantastic for pin trades. Really great for when you're trading high volatility markets, because part of the pricing structure for the Butterfly Condors, you've got a sell side component. So again, when implied volatility goes up, that increases the option price. So by selling a higher implied volatility, option, we get more premium brought in. So it's great for that kind of market as well. Another great use is for trading high price stocks. So, there are a lot of stocks now that, it could be like semi-micro or something like that. These stocks are trading over $1,000. NVIDIA, back when Amazon was, trading over $1,800, those types of stocks were kind of prohibited from, the smaller investor. But with the Butterfly and Condor, it makes these types of trades accessible, which I'll show you an example. So trade durations are great. You could do this for 1 day trade or up to 2 weeks. It's kind of the sweet spot. I like to really go out about 7-8 days out. That's kind of the sweet spot, or 5 to 7 days. We'll give you positive theta, no time decay. So if if you're familiar with options, if you bought options and you're buying options, you know what time decay can do to a position. So with these type structures, there is no time decay. You're going to get capital returns of 2 to 1, 10 to 1. I'll show you one where we had 20 to 1, which was an actual trade. So, your buddy might say, hey, I just made a 2,000% return, and you think that he's lying, but I'll show you some examples where that actually is the case. So here's an example of a short trade using QQQ, using a wide wing put Butterfly, $10 wide or $1,000 per option spread. So great for targeted downside trades. And so in this example, we were looking to go short, and we had QQQ trading here at 314.60, and we're looking for a downside move towards this 305 area. So it broke down through this area here. This was support. So it's breaking down through here. So we were targeting down in this direction. So we were able to do the spread with a very defined narrow risk. And so I use momentum indicators for direction, and then, a lot of Fibonacci levels kind of for, what I call price trigger points. So when they break. So with this one, we did this targeted trade using the Butterfly, and we're targeting a downside kind of target point of the 304 price. All right, so it was trading here at 314.60. It was breaking our support zone. So we went out and bought the 314 put, sold the 304. So there's your $10 wide spread there. So this is balanced. Then we sold the 304 put and bought the 294. So $10 wide spread. Okay, so the spread cost here was $2.10, a debit cost per one contract or spread, Butterfly. Spread width was $10 wide, $10 wide, so $1,000 less our cost would give us a potential profit. If it hit that profit tent, that butterfly body right there would be $790 or a 376% return. So risk $1 to make $3.76. Now, if you'd done just the ETF and you were shorting it, looking for that move to 304, and you got the move to 304, well, you would have made $10.60 per share. But look at your return, 3.36% return on your capital versus here, you can make a 376% return. So just a very dynamic structure, and they're a lot of fun to trade as well, and very exciting when you get one that's really starting to pin. So here's where it went out within the butterfly tent. So not perfect, but it went out right here. So it's trading here at 306.17. We were targeting that 304 strike, so it overshot a little bit, but it was still, we had this big profit zone. So it's trading right here at 306. And so the trade at that point went from $2.10 or $210, and now it's trading at 782. So we had a profit of $572 per spread, which on that risk of 210, that's a 272% return. Versus if you did the shares, you would have made 3.6. So just there's no comparison as far as risk reward. And the question, will you show how to close out a butterfly? Sure, I can just a quick explanation. A number of different ways. One thing you want to be aware of is your short strike, right? So in this example, with it going out right here, your short strike was going to be the 304. So it's above that short strike 304. So you're basically here long a put, short a put here at the 304, then you're short a put, and then you're long that put here. So with it going out here, you have to do nothing because the put debit spread will expire. You know, you're going to make your max profit here, and then the credit spread is going to expire worthless. So there's nothing to do. Now, if it was going out right at your short strike, what you want to do is close out the credit spread side, and then you can leave the debit spread side. But anyway, I'll talk a little bit more about this a little bit later because there are a lot of little variations and little tricks you can do to know how to manage the trade. But that's kind of hopefully basically kind of how you do it. All right, so that's a look there. So over 270% return there. Now this is a really great example. So I always like to show this one because this is back when Amazon was trading, about $1,800, $1,900 per share. And so this is to show you the benefits of this amazing structure. So it's a high price stock, which you're going to lower your risk. This is used for a directional wide wing butterfly on Amazon using a $1,000 wide spread. Now at this point, and this is why I like this example because it shows you how you can play a high price stock. So Amazon was trading, $1,782 roughly. It's trading like this for years, right? So if you were to do 100 shares, which is equivalent to one option contract, right? Equates to 100 shares. You would be out of pocket if you did 100 shares, $178,200. So a lot of risk there, right? Now with this example that I'm going to show you, we were going to target 1830. All right, so we were targeting that based on Fibonacci levels, price action, various things like that. So with Amazon, it was coming down here. This is a 200-day moving average. It was just holding that support and just churning right, up and down in this range from 1830 down here to 1760. So we were targeting a move to 1830, and we were going to do it with the butterfly, and we wanted to very define risk, and we wanted to try to keep our costs as low as possible. So here's kind of the trade setup using the 1830 as our target. Went out and did a $10 wide butterfly targeting 1830. So went long the 1820 call, short the 1830, then short the 1830, bought the 1840. So we had a $10 wide butterfly, call butterfly like this. Now look at the cost of the trade. So versus, if you had bought 100 shares right there, you'd be out over $178,000, right? But we did this with the butterfly, and we had a cost, look at this, 80 cents, $80 per share per spread and we were controlling a price stock that was almost a $200,000 stock. So look at the potential return. Now it's a $10 wide spread. Our cost of the trade is 80 bucks. So potentially this can make $920 in this area or anywhere in between here, still a great return. So this had a potential to theoretically, not theoretically, to make 1,150% return, which you risk $1 to make 11.5 versus risking, I mean, think of 178,000 the risk there if the market goes down. All right, so it's just a beautiful way to go. So here's the other thing I wanted to point out. So this is the day of expiration. So this is in the morning, early, like say 9:30, 10 o'clock in the morning Central. At that point, this was kind of overshooting. It was trading at 1836. So it was trading right there, right where that purple line is, still within the 10. So it went from 80 cents or $80. Now it was up to 230 per spread. All right. So that's still a nice return. That's $150 per butterfly spread or 187% return. So if you did one butterfly spread, you were currently at that point 150 bucks or 187% return. But the thing that I want to point out is that later in the day, around 1:30, this thing was up then 4 times the value, because see all that black area in there? That's what's left of your time component and volatility inside the option structure. And the longer we can wait into expiration, that's going to get sucked out if we're within this price range. So let me show you the difference here later in the day, the same day. So here it was later in the day, say around 2 o'clock or so. And you can see now the price, now it come back down a little bit closer to the top of the butterfly tent, but it was trading right here. But look where your profit was. Now the trade had gone from 80 cents or 80 bucks. Now it was up to $695 per spread the same day. So you were up to $614 profit per spread right there, or that would be a 769% return. Again, if you did the shares, you would be at 2.69%. And earlier in the morning, this was up $150 per spread, which was, what was that? 187% return. So we went from 187% return in the morning to 769% in the afternoon. And it's just doing nothing, just having that volatility and time being stripped out of that spread. So that's such a really great component of the trade. Now here are two really cool trades. These are really always get me excited. So this is a penny trade on Tesla. So Tesla is a great stock for trading butterflies. And so this one we were looking for a specific strike price where it was going to go out at expiration. That's what we call a pin. So did this with a $500 wide butterfly. So the Tesla was trading here at on the 15th at 166.50. Expiration was on the 19th, just a few days later, and we were targeting $180. So this was a very area of a great amount of support resistance, what I call price action resistance, and there was a whole lot of option activity there too. So we did this butterfly $5 wide to target that specific 180 strike. So we did this with a $5 wide butterfly, bought the 175, bought the 180. It was trading right here at 166 when we did it, and then sold the 180, 185. So $5 wide spread. So did the spread for a total cost of 40 cents or 40 bucks. So the potential then profit would be your spread with the 500 less 440. So $460 per spread profit, which that, if you hit it, would be 1,150% return, risking $1 to make $11.50. All right, you see that right there. So, I mean, these are definite trades that you make these tremendous returns on this small amount of risk. So here it was, this went out almost to the penny at the top of the tent. So on the day of expiration, that 19th, this was trading at $799.99 right here. So this went from $40 to $291, right? So this was up $451 on your risk of 40. So that's a 1,128% return, risk $1 to make 11.28. in 5 days. Now the next one is one that really I still am amazed at this one. This is one we did just a few weeks back, and this is what we call our lotto ticket, the butterfly. So this is one of my members, and he really summarized it really well. He said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account. So with all the so-called low-risk option strategies being sold to the public, an account without the potential to hit that big one once in a while without, betting the ranch or the farm is really a slow ride up the hill. So, but this strategy is easy as ABC. So that's why I was saying earlier, I try to look to, let's hit singles, doubles, and singles, and then occasionally you're going to hit this one that Bill calls the big one. So here's one. I've got alert service too, and we send out these types of trades, but I just wanted to show you this. This was one of our alert trades. So we set this out February the 8th. And so you can see here it says new Tesla. This is what we call a long binary monthly butterfly pin trade. So Tesla was trading right here around 189.35 when the trade was sent out to execute it. So this trade was set up for a potential expiration pin at 200 the next Friday. So this was like on a Monday or Tuesday, I believe. So sent this trade out. So this was doing a butterfly, the 197.5, 200, 202.5, $2.5 wide butterfly at, look at this, 12 cents or $12. So that was going to be your debit page, your risk. Now on the 16th, here it was, just to kind of highlight it, it was going out, it was trading at that day, it was trading right around 200, right where we wanted the pin. So now it was up $215 per spread. It was up 1,790% return, and there was still more profit in the trade. So at the close, towards the end of the day, I sent out this alert, said, wow, almost a perfect pin. Actually, it was a perfect pin. So now it was trading at $200 basically, and the butterfly now was up $230 per spread or 1,916% return. So this was just rarely do you ever see it, pin this exact. So I was pretty amazed with it. So here it was. We set the trade up on this day, the 6th, or I'm sorry, the 8th. It was trading down here at 189.35, targeting this area here at 200. And so here's the spread diagram of what it looked like. So we had the trade cost right here, max loss trade cost $10 or $12, and our potential profit is $238. So it's a $2.5 wide spread. We put it on at 12 cents right here, 12 bucks. So here's your potential return, $238. That'd be a 1,983% return, which this trade actually did make that. It pinned it perfectly at expiration. So here's what it looked like going out. This was on the 16th on a Friday towards the end of the day. At that point, it was trading right here at $200, right there, $200. So this was went from 12 cents or 12 bucks. Now it was to 243. So here's your spread profit, $231, 1,925% return. And here it was, the perfect pin. This just shows you right there at the end of the day where it was. This was about, well, it was perfect. So it's trading right there at that top, boom. So it went from 12 bucks to 250 bucks. That was your max profit, 238, or 1,983% return. So these are types of returns that you can get, with this type of strategy. So here's just one more example. This is on a long call Condor. This is one that we did also in the alert service. This is on Abbott Labs. And so this one we were looking for a move to the upside. It was trading at 116.30. This is what we call a volatility breakout squeeze. So I love the Condor when we have a big breakout potential trade. So you can see how tight this was. This is what we call a squeeze through the dots. So the market's consolidated, just churning, ready to either break up or break down. Now with our indicators, the momentum indicators were telling us that the probability for this breakout here was going to be to the upside. So we did this trade right when it broke out, and so we controlled the risk really well by doing it as a condor. So it's trading at 116, and we were looking for a move up here towards this kind of 120 area. So we set this up, very low defined risk trade, doing a long call condor, and that was, let me get rid of this pointer. I can't get rid of it, hold on. So we did this with the Condor structure. So basically, we can leg in or do it all at once with one spread. So we were here along the 116 call, short the 118 call debit spread, and then we had short the 119 call along the 121 credit spread. So you can see the structure, it looks like this. Okay, so you can see that call debit spread, the call credit spread, and we had this put on for a max risk. The beauty of it is our max risk is structured for, in this case, $67 per spread. Now it's a $2 wide spread, so less 67. So potential profit, if it goes out in this zone here, is $133, 198% return. So really nice return, but on a very low capital at risk, and also these are going to give us a positive theta. So here was the structure going out right there, what we call the middle of the profit zone right here, going out right there. So it's trading at 118.69 into, you know, the day before. So we went ahead and took it. We were thinking it could pull back or so. So here was the profit, went from 67 bucks to 178 bucks. So $111 per spread, 166% return on that trade there. So here's one we currently have on. This one is on Microsoft. It's very similar. And let me show you what it looks like on Microsoft. One second, let me pull it up. I'll just show you what that looks like currently. We've got this trade on to show you. This is on Microsoft. And we were looking for this one to breaking this 420 area. We're looking for this one to potentially break up here and go towards this 435 area. So we've got this set up as a long call Condor. This is what we call a broken wing Condor. So we set this one up, I think we set this up last Friday. And so this one, you can see we've got look at the trade risk. We've got this set up for $47 of risk. We actually did one adjustment, but now our debit risk, our risk is $47. That's it. That's all we could lose. Okay, so if it went outside of the long wing here or above that, now this trade currently right now is up $60. Okay, right there, $63, and that's on our risk of 47. So it's over 100% return. So currently this is up. So what is that? 63. If I can calculate this, 63 divided by 47. This is up 134% return. Now this is for expiration this Friday. So if it goes out here between the two spreads, this will be up $203, which will be over 200% return. So that's just another example, of using this kind of structure. So really cool structure, and then we have one more on. I might as well show you. We have another one that we currently have on, and this is on ExxonMobil. So this is one that we did on ExxonMobil. We started out this trade with what we call a long call calendar diagonal, and then we adjusted this last Friday into a butterfly targeting this 113. So we're still in this trade, and here's where this trade is currently at. So you can just see the tremendous returns. So we have this trade structure now into a butterfly after a number of different adjustments. And so we're long this trade. So we're long the 107. So you can see down here, so we're long the 107 call, short the 113, short the 113, long the 119. So we're, targeting this 113. Now this is for Friday's expiration, but this is currently up right now, $451. Okay, so this butterfly, so 451, and our risk after the adjustments that we did is 20 bucks right there, 20 bucks. So you can do the math on that. 450 divided by 20. This thing is up. This is up 2,250% return. Okay, 2,250% return. Okay, so we're up. Here's that 470, so it's up 450. 450 on our risk now reduced down to 20. Huge return. Okay, so that's the excitement of it, and so what you can do if you just know how to do it and when to do it. So those are a couple of interesting trades. Those are some really great ones to show you. Now, what I've got for everybody here, and I'm really excited about it, is if you'd like to master these high reward, low risk trades that work in any market environment, here's what you can do today. So I've got a nice special on for everybody's here. And if you'd like to take advantage of it, I've got this course. We just completed this. This is my Butterfly Long Condor Options Masters course. Just completed this the first weekend in March, March 24, 2024. So if you sign up today, you're going to get the 6-hour on-demand trading course. Use this link here. Make sure this is right. Okay, use that. You should be able to click on that. Let me click on it, and it'll pull up a payment link. And then just, okay, so you can see here, you're going to be, here's your payment link here. It'll come up here. So just click on that, and you're going to be able to buy this master's course with all the different bonuses that are included, which I'll go through. And if you do want my indicators, you can also get those today for $195. Those are the indicators I kind of showed you earlier. But here's what you're going to get with the course. So it's actually turned out, this is almost a 7-hour long course, but it's recorded and broken down into modules, for easy viewing, and you go back. Now this course will be yours forever once you buy it. It'll go into your own special kind of cloud place where you can always log in and get it. So with this course, you're going to get if you go to my website, the course is for sale on my website for currently $397. So I'll show you that. So you're going to get this course here today for $197. And let me show you this course. So if you go to my website, powercycletrading.com, and you go here to courses, trading courses, click on that, and come down here, I'll show you the butterfly course is currently for sale on the right here for, if I can find it, where'd it go? Must be right here it is. Oh, here it is right here. We just completed this. So this course on the site is for sale for $397. But for everybody here today, it's going to be $197, so 50% off. But not only that, you're going to get these additional really nice bonuses. So you're going to get my Start Trading Options Today. So a really great intermediate beginners option course. That's for sale at $197. The course, you get that. Then I'm going to also give you a 30-day trial membership to my trading club. So this is going to give you access to my trading room, which is open each and every day. For an hour every day in the morning. So you're going to get access to that. If you'd like to stay, then it's $97 a month, or we have some other programs. We're going to we'll do a follow-up live Q&A that you'll be sent email to, and that's a value of $300. And then you're going to get another really nice option trading course called my Option Trading Tutorial. So 60-page option guide course with videos, and this is more on the Greeks, delta, gamma, theta, things like that. You'll get that, and then you're going to get my complete option strategy manifesto. So 15 different other option strategies. So the value here of all these bonuses, $738. So total value of this package, $1,135. Everybody here today will get it for $197. Yours, it's forever. You don't, if you decide you don't want to stay with us, hopefully you will. It still will be your course. So that's what everybody will get here today. So just use this link here. I'll put it in one more time, and be looking forward to working with you, everybody here in the future. So let's go through what you're going to get, and then any questions I'll be happy to take. So this course, we just completed it. So 6-hour recorded course and easy to view 30-minute modules. You get the PowerPoint training manual. This was a very extensive course, over 400 pages with a lot of trade setups and examples. So it's kind of what I call my blueprint course that just goes through the Butterfly Long Condor, how to use it for income, high reward trades, non-directional hedging. Now the course here, part 1, I always like to start with the Greeks, how they work and the importance of, the things you need to know. So the various Greeks that affect the Butterfly Condor, such as time decay and its impact, on the Butterfly Condor, volatility crush, what that is, and how that works on these spreads, and then how pricing the option works to take advantage of time and volatility. And then we go into the course 2. We have a chapter here on using Fibonacci price target mapping and standard deviation to select our probability targets for the body of the butterfly. So a really important part of that course there to teach you how to go about and, find these profit targets that you want to trade to. And then part two, we get into every different variation with examples of how, why, and when to all use every variation. So we'll go through examples of using a long collar put butterfly, using a wide wing butterfly, a broken wide wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, lotto butterfly, vacation butterfly, long condor. That's why I was saying earlier, it's like, Bubba Gump shrimp. Have you ever been to a place, you can get fried shrimp, shrimp étouffée. The butterflies like that. So, the course is great because you see every variation, why it would be used, when you could use it, and then you can make a decision on which one you want to use and go from there. So that's in part two. Goes through, okay, what are the best option timeframes to use? How far out should you go? What are the best stocks, ETFs to use? And then how do you get that structure where you get the 10 to 1 or higher on risks as low as $10? And then how do you profit from that volatility crush or theta decay? And then a really fun part is just which we do a lot of these are the monthly penny trades. So this gives you another potential 12 times a year to make some really fantastic profits on very low risk. So we go through that, the big part of the course. So the pinning, so how you set up your targets for your pinning trades using option activity and Fibonacci levels. So very detailed course on how to do this process step by step, how to go through it all. And then we go through the long condor, what that is, how it's used to give you returns at 100 to 300% returns are typical. How and when to use the long condor in your directional trading. So this is not an iron condor, it's a long condor, totally different animal. And then part three is just another part of the course dedicated to hedging. So it goes through what we call the progression of hedging. Then it takes you to how to use a butterfly condor for hedging a core position, such as a credit spread or debit spread. And then how to use the butterfly defense to defend a vertical debit spread or credit spread. So step-by-step checklist, how and why to put the butterfly condor on, and then execution risk management and what is assignment risk. How can you assess assignment risk so you're not going to be assigned, expiration risk, auto exercise, and then you get a trading library of a lot of past trades on butterflies and condors, which I think really help you to understand and how to trade things. So this was from one of my members said, Alicia said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like this. Wish I'd found you sooner, but I'm glad I found you now. Thanks again for your time today, Alicia. So appreciate that. And then here are the bonus specials. So first off, you're going to get bonus 1, start trading options today. So it's kind of an intermediate beginner's course, but it'll take you through the benefits of options versus stocks, some really good insider tips. What's the difference between puts and calls, option basics, expiration risk, and then you're going to get a couple different strategies, covered call, and then a covered call with a protective put strategy and a debit spread strategy. So that's a really nice beginner's course. And then you're going to get one 30-day trial membership. You can start this whenever you want. You can go through the course first, then start it. But you get access to my virtual trading room every day during the week, 9:30 to 10:30 Eastern, Monday through Friday. Then I do a daily video newsletter every night after the close on the markets. We do a weekly Q&A live and recorded usually every Tuesday. And then you'll have a trader's educational vault with a lot of good trading material. And then everything on my website, you'll get a 60% discount. So here's David. He said, best trade service. I've been enjoying your daily sessions, making money to increase my retirement account. Seriously consider Larry's truly rewarding educational service. And then bonus 3, we'll do a follow-up Q&A. So we'll send you out a link to that. It'll be recorded and live and recorded. And then you're going to get this is a really nice course, 60-page course with videos on the Greek. So showing you, going through really what delta, gamma, theta, how option pricing works, what we call the market maker secret, how to use standard deviation, option delta, trade probability. So this is just a bonanza package on options. And then last but not least, my 15 option strategy guide. So here, if you're wondering what the heck is a back ratio spread or a ladder spread, so it'll take you through all these different variations of these other types of structures. So you're going to be, really going up the curve quickly with everything you'll get here from all these bonuses. And then my option Greeks. So this is something you print out, put the Greeks on your desktop, and go from there. So hopefully, I hope everybody here got something out of this presentation and can see the excitement and beauty of using these two structures. And hopefully, you'll take advantage of this offer and join me at Power Cycle Trading.